where smart investors actually put their money. Have you ever noticed something strange about investing? The more experience people gain, the more money they accumulate, the more complicated their portfolios seem to become. They own index funds, ETFs, mutual funds, maybe even alternatives. And yet, when you ask them a simple question, why do you own this? The answer is often unclear. Some people point to Warren Buffett and say, index funds are all you need. Others quietly mention hedge funds, private deals, and complex strategies, as if they've discovered a secret door most people don't know exists. And somewhere in the middle is where most investors live. Already invested, already committed, but not fully confident. This video is about removing that uncertainty. Today, we're going to calmly and clearly break down the 4 major investment vehicles every serious investor needs to understand: index funds, ETFs, mutual funds, and hedge funds. Not from a hype perspective, not from a sales perspective, but from a decision-making perspective. By the end of this video, you won't just know what these vehicles are. You'll know why some are praised, why others are misunderstood, and why many investors choose the wrong one for their actual goals. Most importantly, you'll understand how to think in systems, not products. And later in this video, we'll connect this investing mindset to something equally important: how intelligent systems create income without constant effort. But first, we need to clear the fog. Let's start with something simple. Strip away the jargon, the charts, and the marketing language, and every investment fund works the same way. Imagine you're planning a massive dinner party. Buying everything yourself would be expensive and inefficient. So instead, you and 50 other people pool your money together. Now you can buy in bulk, access better ingredients, and hire professionals to manage the process. That's what an investment fund is: a pool of money, managed according to rules, used to buy assets on behalf of many people. Here's the key question most investors forget to ask: who benefits first? Because every fund has costs: management fees, operating expenses, transaction costs, and those fees are removed before returns reach you. The difference between investment vehicles is not just what they invest in, it's how decisions are made, how often they trade, how much control you have, and how much you pay for the process. Keep that in mind as we move forward, because the rest of this video is simply comparing systems. Index funds are often described as set it and forget it, but that phrase hides what makes them so effective. An index fund does not try to win, it tries to represent. Instead of selecting stocks based on predictions or opinions, an index fund simply follows a predefined list. The S&P 500 is a perfect example. It holds the 500 largest publicly traded U.S. companies weighted by their size. When companies grow, their influence grows. When companies shrink or disappear, the index adjusts. No opinions, no forecasts, no emotions. This simplicity has consequences. Because there's no active decision-making, index funds don't need expensive managers or research teams. That's why their fees are extremely low, often between 0.02% and 0.20% per year. That difference may sound small, but over decades, it compounds dramatically. Here's what many investors don't realize. Index funds aren't exciting because they outperform. They're powerful because they underperform less. They lose less to fees. They avoid costly mistakes. They remove the human tendency to interfere. The trade-off? You give up flexibility. Index funds trade once per day after the market closes. You don't control timing. You accept the market's return. For long-term investors, that's often a feature, not a flaw. But it's important to understand the limitation. ETFs, or exchange-traded funds, are often confused with index funds, and for good reason. Many ETFs are index funds. They simply exist in a different wrapper. The difference is how they trade. ETFs trade throughout the day, just like stocks. That gives you real-time pricing, intraday flexibility, and more control over execution. This flexibility can be useful, but it introduces a new risk: behavior. When investors can trade easily, they often trade too much. They react, they adjust, they second-guess. So ETFs reward discipline, not activity. From a cost perspective, ETFs remain efficient. Most charge between 0.03 and 0.75% annually, and many brokers now offer commission-free trading. ETFs also offer broad market exposure, sector targeting, international diversification, even commodities or bonds. This makes them ideal for investors who want structure without rigidity. The key is using ETFs strategically, not tactically. Mutual funds are where investing becomes more subjective. Most mutual funds are actively managed. That means a manager or team is making decisions about what to buy, hold, or sell. The goal is simple: beat the market. In theory, this sounds appealing. In practice, it introduces two challenges. First, cost. Actively managed mutual funds often charge between 0.5 and 1.5% annually. And second, consistency. Over long periods, the majority of active funds fail to outperform their benchmarks. That doesn't mean all mutual funds are bad. They can be useful for niche markets, specialized strategies, certain international exposures. But they require trust. Trust in the manager, trust in the process, and acceptance of higher costs. They also trade once per day, just like index funds, which means flexibility is limited without the cost advantage. Hedge funds are often surrounded by mystique. They're associated with wealth, exclusivity, and advanced strategies. And to be fair, they do use sophisticated tools: short selling, leverage, derivatives. But sophistication does not guarantee superiority. Hedge funds typically charge a 2% annual management fee plus 20% of profits. This means they must significantly outperform just to match simpler alternatives. Some hedge funds succeed, many do not. What you rarely hear about are funds that quietly shut down, funds that underperform and disappear, and survivorship bias. Hedge funds are designed for asymmetry. That can be appropriate for some investors, but it's not a default solution. At this point, the picture should be clearer. Each investment vehicle serves a different role. Index funds prioritize efficiency. ETFs prioritize flexibility with structure. Mutual funds prioritize expertise at a cost. Hedge funds prioritize complexity and risk. The mistake most investors make is mixing vehicles without intention. They collect products instead of designing a system. A stable portfolio doesn't feel exciting. It feels boring, predictable, understandable. And that's exactly why it works. Here's an interesting observation. The same principle that works in investing also works in income creation. Simple systems outperform complex ones. Whether you're allocating capital or building income streams, clarity compounds faster than activity. That's why many investors eventually ask a new question: how do I build income that isn't directly tied to my time? That's where structured education matters. Not hype, not shortcuts, but systems. If you want to understand how people build scalable, repeatable income systems online without showing their face, there's a structured program linked below that focuses on clarity, automation, and leverage. It's called Tube Mastery and Monetization.
not as a quick win, but as a system, just like investing should be. Investing success doesn't come from complexity. It comes from understanding what you own and why you own it.
When you replace confusion with structure, decisions become easier, and over time, boring systems quietly win. If this helped you think more clearly about investing, support the channel by liking the video. It helps more than you think. Share it with someone who values long-term thinking, and subscribe for disciplined strategies that compound over time.